Hello everyone. In this session, which is another technical session in our investment banking course, we are going to analyze a specific methodology that is used by managers of investment vehicles, particularly if they are working in early stages of the life of the company. So we are talking about venture capital or growth to understand how much to pay for a specific investment to be inserted in the portfolio investments. As you remember, when we have to deal with companies in the very early stage of the project life, we have to do with bets because the degree of uncertainty that is surrounding such investments is sometimes huge. And so traditional methodologies to assess the value of the company, typically the discounted cash flows, lack of some key variables, either parameters with which to compare the company with an existing one, or time series that can help us understanding how the company went in the past. For this reason, the practice has developed a method called venture capital, private equity method, that we are going to use in this session in order exactly to understand how typically these investment vehicles work when deciding how much capital to give to a specific investment, how much to pay, and how much percentage stake in terms of percentage of capital will be acquired. In order to follow me in this discussion, you have to follow me using the slides that I have uploaded in your Blackboard platform. More precisely, the slides that I'm going to use are essentially represented by this set of slides, private equity, the venture capital method, and contractual schemes. And I will complement the discussion with, as always, an electronic whiteboard that I will use in order to explain what I'm going to say. And in addition to this, a specifically designed Excel file that will be helpful for us when we will have to analyze the use of the private equity method in multiple stage financing. You have this file called as stage financing XLSX. So I strongly recommend you to have these two files at hand. But in order to start warming up a little bit the discussion, let's see essentially what we are going to discuss. So the agenda of today. For this session, essentially what I'm going to use is a very short menu. And in fact, the menu is composed by the following points. The first one, we have to understand exactly what the private equity method or venture capital method is, to understand the key basic differences in between this method and traditional methodologies for analyzing and assessing the value of a firm. We will see that this private equity method can be applied according to the type of investments that we are making in two different kind of versions. The first one is when the private equity investor is carrying out a single stage investment. So essentially, the company is looking for money. There is only one private equity investor that is providing money to this company, and so we have only one moment where this capital injection is carried out. Very frequently, particularly in the very early stages of investments, and you can name a number of companies that have benefited from this kind of version. Uber, for example, was a typical Paramount case. The other one recently was WeWork, and we are discussing of two very big companies, so-called decacorns, so unicorns that have a valuation that is at or above 10 billion US dollars. They typically experience multiple stage financing. So in a sense, the amount of funding that is required to the company to grow is not provided by one single investor, but by more than one investor at different stages of the project life. So, in a sense, what we are going to discuss is essentially a session where I will start from a very basic application, the single-stage private equity method, and then I will complicate a little bit the story in multiple rounds of financing. Round A, round B, round C, as long as time goes on. To be very honest, there is not much difficulty in understanding what I'm going to say. Important is that we capture exactly the essence of what these investors are doing. Essentially, the idea is that the company is looking for money, and investors can have a risk-return kind of inclination that is different as long as time goes on. The guys that enter first will be characterized by a high risk-return profile, and so they will require probably a high remuneration for their equity injection. The more the company goes through the early stage up to the what we have defined, the growth stage, the lower the return required, because arguably the risk will be lower. But to put everything in good order, let's start essentially with some basic intuitive indications for what concerns the private equity method single stage. To clarify exactly the basic difference in between a traditional company valuation and the private equity method, I will basically put on this whiteboard some basic elements. As you know, in normal corporate finance, when we have to assess an enterprise value of the firm, typically what we do is we take for a certain number of years then the unlevered free cash flows of the company. These are the unlevered free cash flows of the company, and we discount these unlevered free cash flows to present using an appropriate discount rate, which typically corresponds to the weighted average cost of capital. After having done this, we get the enterprise value, and deducting the net financial debt, we get essentially the equity value of the firm. In reality, when we are discussing the typical way a private equity investor works, the story is different. In a sense, when we work in the private equity world, particularly when the private equity world is characterized by a very early stage company with still a very uncertain pattern to the future, typically what these guys do is to understand a realistic exit value for their investment in a given time horizon. Do you remember? Typically the holding period of a private equity investor is in between 3 to 5 years. Typically 3 years for a venture capital, 5 years for a private equity investor. And what these guys typically do is, since I have declared to my investors an expected internal rate of return of this investment, what I do is to try to understand, given the expected internal rate of return on the specific holding period, which is the compatible entry value that we can pay so to be compliant with a given exit value and a given time frame and an expected IRR. And guys, I want to be bold on this. The expected IRR is not the internal rate, is not the weighted average cost of capital of the company. So it's not a specific measure of the risk of the firm. The expected internal rate of return is a subjective valuation of the risk, if you want, of the bet that the investment vehicle is doing in a specific company. So depending on the kind of investor we have, we could have multiple compatible value at entry for this specific company. So we don't have an objective valuation, but a subjective valuation that depends on the risk profile of that specific investment. If this is clear, at least from an intuitive point of view, we can now try to put together a little bit some numbers in order to clarify exactly how a typical simplified private equity method typically works. In order to do so, I ask you to follow me in the first example that I have prepared for you, and that you can retrieve in slide number 3 of your set of slides. In particular, follow me in this example. We have a specific case where we have some basic information regarding the firm. We know that our private equity investor, the private equity investment fund, is willing to invest an amount of 3.5 million euros today. And we assume our analysts have drafted an expected business plan, and we assume that, considering the investments of 3.5 million euros we are going to make today, we expect the company to be able to generate a net income in 5 years' time from now of 2.5 million euros. This is what, in technical terms, is defined as the post-value, post-money value valuation. What is post-money value? This means that the assumptions we are making are referred to a business plan that is already taking into account the injection of 3.5 million euros equity capital in the company today. If you want, put differently, thanks to this 3.5 million euros, the company will be able to generate an amount of 2.5 million euros net income in 5 years' time. So, returning to our example, we can essentially see what our case is telling us. We assume that at the end of the 5 years time period, we can exit the company with a multiple price earning of 15 times. And we assume that our young analysts have applied this multiple based on comparables valuation. And last but not least, we have a target IRR for our investment, which is 50% per annum. Don't be surprised of such a huge amount of money. If we are working in venture capital, given the very high level of risk of this bet, it is pretty common to require a very high level of internal rate of return on an annual basis. And last but not least, we assume that before we enter in the capital, the founders of the firm have already issued a number of shares corresponding to 1 million shares. What this first example requires us to do is to determine, first, the equity stake acquired by the private equity investor. Second, the number of shares purchased by the private equity investor. And technically speaking, we will be more clear on the meaning of these two terms, the pre-money and post-money value of this company. Please put on a table these information that are useful for us, because we are going now to execute the example step by step. So allow me to use again the whiteboard to put together all the different elements of our analysis. So the idea is more or less the following one. We know that our supposed investment is going to be executed in between year number 0 and year number 5. We know that in year number 5, the net income of this company is expected to be 2.5 million euros. And we expect to exit the company based on comparable valuations with a price-earning ratio that is 15 times the value of the company. Furthermore, what we know is that this investor is willing to get for this investment an expected IRR on a yearly basis corresponding to 50% per annum. And last but not least, we know that we, investors, want to deploy an investment amount of 3.5 million euros. So we have decided to allocate 3.5 million euros to this investment, and the number of outstanding shares that are in the hand of the founding members, the existing shareholder of this company, is corresponding to 1 million euros. 1 million shares, sorry. So, how to put together these pieces of the puzzle? First of all, it is easy to understand that we can calculate, given the final exit elements, the net income and the price earning, the exit value of the company. So, essentially, the exit value of the company can be easily determined, and that this is the equity value, because we are applying a multiple of equity to a net income. It is 15 times 2.5 million, which corresponds to an amount of 37.5 million euros. So now we have the value that we assume the company will have when we, private equity investors, exited the investment in 5 years' time. But you know that in 5 years' time, we have an expected return for this investment, which is 50% per annum. So you can easily imagine that if we want to calculate how much is the expected value the company must have today in order to allow us to have a 50% per annum internal rate of return, what we have to do is to discount this value, 37.5 million, for 5 years' time at an internal rate of 50%. So that the equity value of the company in T0 can be easily calculated as the present value of 37.5 million euros divided by the discounting factor 1 plus 50% or 0.5 power of 5 years, which is the exit horizon for our investment value. This value returns us a value of about 4.938, roundings apart, million euros. So what we know is that today 100% of the company value, and please remember that this is a value calculated assuming a net income of 2.5 million that already takes into account our equity injection of 3.5 million euros. So it is the value of the company including our investment of 3.5 million euros, what we define as the so-called post-money value. It is the value of the company after having received a capital increase of 3.5 million euros. So now another piece of our exhibit tells us that the equity value at T0 of our company is 4.938 million euros. Now, what we have to do is to take into account two elements. The company overall has a value today of 4.938, which is compatible with an internal rate of return 50%, an exit time horizon of 5 years, and an exit at 15 times, and 2.5 million euros net income. Now, what we have to do is, if we want to invest 3.5 million euros out of the total value of the company of 4.938, this means that the equity stake that we are going to buy in this company can be easily estimated as the ratio in between the two values. And so 3.5 million euros, our investment, and 4.938 million. Or, if you prefer, an equity stake of 70.9%. So, if we invest, let's revert the reasoning, an investment of 3.5 million euros in a company who currently has a value of 4.9 million, and we assume to take this investment ahead of time for 5 years, and we gain a 50% internal rate of return, we are compatible with an exit value of 37.5 million euros. So we have inverted the reasoning, and the story holds. So we know now that with the 3.5 million, we can buy an equity share, an equity stake of 70.9% today. And this is the first answer to our slide. Calculate the equity stake acquired by the private equity investor, and the equity stake acquired by the private equity investor is 70.9%. The number of acquired shares, the pre-money and post-money value. So let's go on with our reasoning, and let's return to our whiteboard. We know that we must buy 70.9%. How many shares are we going to buy? My students typically make a mistake. And the mistake is the following. They say, Professor, we have today 1 million shares as per the data provided in the text. If we have to buy 70.9, we will acquire a number of shares that corresponds to 709,000 shares, which in principle is a reasonable kind of argument. However, think about it. If you make a calculation of this kind, you are making a mistake, because if you take 709,000, your equity stake, and you divide it by the number of existing shares pre-capital increase, and you sum 709,000, this value doesn't give you 70.9. And you can imagine why. This calculation is correct only if you assume that this deal is a buyout. You are buying from the existing shareholders 70.9%, and the number of outstanding shares doesn't change. But this is not the case. You are entering in this company via a capital increase. So by definition, you will not have 70.9% of 1 million, because after the capital increase, the number of shares will be higher than 1 million. So at the end of the day, we have to do a different kind of reasoning. And this reasoning is the following. We can basically say, and follow me in the reasoning, if we want to buy 0.709 or 70.9% equity stake, we want this equity stake to be the number of shares for the private equity investor divided by 1 million shares, existing outstanding shares, plus the number of shares for the private equity investor. So our X in our equation is this amount and this amount. Resolving the equation for the number of shares For the private equity, you will see that the number of shares that is purchased by the private equity investor is much larger than 709,000, but it is, roundings apart, the number of shares of 2,433,476 shares. So if you take the ratio of 2,033,476 and you divide by 3,433,476, you will receive exactly an equity stake of 70.9. So also the second question of our slide has been solved. We asked basically the percentage acquired, 70.9, the number of shares acquired, and the number of shares acquired is 2,433,476 new shares. And we must now close the reasoning, calculating the so-called pre-money and post-money value of this company. So essentially, the basic idea is now to understand the next step. So essentially, what we are going to do is to complete the exercise, calculating the pre-money and post-money valuation. Let's go on again in our reasoning and let's see what happens. Let's return to our whiteboard. The outcome of this whiteboard is essentially that we have a total number of shares acquired of about 2.4 million number of shares. So essentially, what we do is, since we know that we want to invest based on our data, an investment of 3.5 million euros today, and we are going to invest in a number of 2,433,476 shares, you can immediately understand that the price that you pay per single share, so the price per share, is the ratio of the two numbers. So we are going to buy every share at the price of about 1.44 euro per share. And now it is easy to understand that the two values that we have to calculate, the post-money valuation, the value of the company after the capital increase has been executed, and the pre-money valuation. Please notice the pre-money valuation intuitively is the value of the outstanding shares that the existing shareholders own before the capital increase is launched, based on the valuation corresponding to the round of financing, 1.44 euro per share. So really now everything becomes, I would say, pretty intuitive. You know that your company today is a thing of this kind. Follow me. You have a company that overall, in terms of number of shares, has the original number of shares outstanding, 1 million, plus the new shares issued for the capital increase, 2,443,476, times what? Times, of course, the price paid today by us, investors, to enter in the company. And as you can appreciate, this value corresponds exactly to the 4.938 million euros that we had calculated here, the present value of the company today after the capital increase, post-money value. How can we split this value? Very easy. The first component of our equation, this one, corresponds exactly to the 3.5 million capital increase. So this is the value of your capital increase. While instead, and this is the intriguing story, the implicit value that, since we have valued the company 1.44 euro per share today, that we can assign to the equity stake of the founders is 1 million times 1.44. This is the so-called implicit value of the company before the capital increase, before we enter inside the company. So if we consider the implicit value before the capital increase, we define this value as the so-called pre-money valuation compared to the post-money value that we can assign to this company. So in a sense, closing our first example, we can comfortably say that we have answered to all the questions of our slide. We said that buying 70.9% equity stake, we are buying 2.4 million shares, giving an implicit value to the company before the capital increase is launched of about 1.44 million, and a post-money value of the company today that corresponds to about 4.938 million euros. Pretty easy to understand, I believe. So, with this first step, we have concluded basically the first part of our discussion. And we are not far from reality. There are companies that, before going public or before being sold to another company, go through only one single stage of investment. They have only one private equity investor. This private equity investor injects money into the company, and then at a certain point it exits. In reality, the practice of venture capital and early stage private equity growth has evolved in the past few years. And it is, I would say, a little bit rare to think about one single investor providing the whole bulk of financing to the company. And you can understand why. Investors have different preferences in terms of risk and return. One investor could not be comfortable in investing in very early stages. Another one instead is very aggressive. He has skills, he has industrial knowledge, and so is also open, adamant to deploy money since the very beginning. For this reason, what we are going to do in this second part of our discussion, returning to our agenda for this session, is to modify slightly our private equity method, moving from the application on a single stage to multiple stages of financing. So we are going to discuss what happens when the investment of 3.5 million euros is provided not by one single investor, but in multiple rounds of financing with arguably different investors at different points in time. In order to do so, we can use again our slides, and we can analyze in a bit more detail the second example that I'm going to show you. And in particular, I want to draw your attention on, again, a slight modification of our previous example. Suppose that the company is looking again to a fundraising of 3.5 million euros. So our objective as the company is to find in the market investors willing to deploy an amount of 3.5 million euros in our company. However, we want to organize our fundraising in multiple stages. More precisely, the situation is the following. In our agreements in between the first investor and the company, we say to the first investor, investor A, the most aggressive, listen, investor A, you know that I'm going to raise in 4 years' time a total amount of funding of 3.5 million euros. You see them here. But I ask you, investor A, to provide only the first 1.5 million euros, for which I know that you require an internal rate of return of 50%, absolutely in line with our previous example. But, investor A, I also inform you that after 2 years' time, and you see T2 here, I'm going to contact another investor B, asking this investor B, a so-called round B financing, for another 1 million euro, and you, investor A, you can assume, based on general market data, benchmarking analysis, that this investor will be keen to invest at an internal rate of 40%. Why so? You can imagine, after 2 years, if the company has got burst, at the end of the day, this second round will never appear. If instead the company is healthy and successful, the company will be less risky than before. And for this reason, the expected return of these investors will be definitely lower than for the first one. But on top of this, when I start fundraising in the first round, I will also tell investor A, listen, investor A, if everything goes well, after 4 years from now, I will go again in the market for a round C financing for an additional 1 million euros, and you can assume that that investor C will require an internal rate of return of 25%. So, at the end of the day, again, the story is the same. If you enter after 4 years and the company is pretty successful, at the end of the day, you can assume that this company will be less risky than before. And so, other things equal, at the end of the day, you should imagine that the third investor will require, all other things, a lower internal rate of return. So, from this point of view, what we are going to do is exactly to replicate this calculation, so determining the equity stake acquired by the private equity investor A, the number of acquired shares, the pre-money, and the post-money value. In order to do so, we have to elaborate a little bit the numbers by considering intuitively a step-by-step approach. So, let's move on in our discussion with really a step-by-step approach. We know that in a multiple stage financing, we know that the company will go through 3 stages, in T0, in T2, and in T4. And we know that the first investor, us, if you want, has a time horizon for exit of T5, so 5 years time. We know that the investor today is willing to deploy an amount of capital which is 1.5 million euros, and that in a deep time horizon we have an expected IRR of 50%. So if we want to make our expected IRR to be true, and we invest today 1.5 million euros at an internal rate of return of 50% for 5 years, this means that the exit value that we want to have in year number 5 should be 1.5 million times 1 plus 50% power 5, which basically means that the implicit value that makes compatible 1.5 million with 50% should be 11.390 million euros. Investor A, however, and this is our investor A. Investor A, however, knows that if the company is successful after year number 2, after 2 years, so after 2 years, which basically means that the second investor will enter in 2 years, this investor will deploy an amount of 1 million euro. And assuming that we want to take a picture of the company in year number 5, this investor, in between year number 2 and year number 5, according to the numbers that I've shown in our slide, will require an internal rate of return of 40%, which basically implies that the corresponding value of an investment of 1 million euro at an internal rate of 40% in year number 5 corresponds to an exit value of 1 million times 1 plus 40% power of 3 years from year number 2 to year number 5, which corresponds to an implicit value of 2.744 million euro. I want to be bold, guys. I'm not saying that investor B will exit in year number 5. No, I'm simply saying how much the equity stake of investor B will be in year number 5 when investor A will exit. So I'm not assuming anything in terms of exit horizon. Very likely, if also investor B has a time horizon of 5 years, he will exit 5 years ahead of year number 2, so in year number 7. What I'm doing is to homogenize all these values at the exit value of the first investor, which is investor A. I want to be clear on that. For the same reason, we can continue with the last investor that will get inside the picture after 4 years. Investor C will enter in the company in a later stage compared with the others. He will enter in year number 4 with another investment of 1 million euro. And since it is the least risk investment, the internal rate of return required is only 25%. So that I'm not saying again that investor C will exit in year number 5. I'm simply saying which is the value compatible with 1 million euro and an internal rate of return of 25% in 1 year time. So essentially the implicit exit here should be 1 million times 1 plus 25% power of 4 to 5, 1 year. Or, if you prefer, an amount that corresponds to 1.25 million. Now, we have almost everything available because, going back to our original example, we know that investor A, so the first investor that gets in time 0, has an expectation of exit corresponding to a net income of 2.5 million euros with an expected multiple at exit, a price earning of 15 times. So we know from the first simplified example that the exit value that we assume to have for the equity of the company in T5 is 37.5 million euros. If we consider the value of 37.5, 100% of the equity in T5, and we know that investor A must have 11.39 million if we want to have everything compatible with the investment and the internal rate and the time horizon. The second investor has an implicit value after 3 years of 2.744, and the third has an implicit value after 1 year investment 1.25. You can easily imagine that these 3 investors in T5 must have a percentage that corresponds to 30.4%, first investor, the ratio in between 11.39 and 27.5. The second investor must have a 7.31%, and the third one a 3.33%. So, from this point of view, it's pretty easy to get these values, taking simply the value of these 3 numbers and dividing them for the equity value at T5. If you take a moment and you have the possibility to retrieve the Excel file that I have uploaded in your Blackboard, you can immediately see that these three numbers are the ones that I'm showing in this part of your Excel file. Look carefully. What we see here is in this part of our Excel file, we have the years 0, 2, and 4. We have the investments that are made by investor A, B, and C. And we have the rounds of financing, 1.5 million, 1 million, and 1 million. The required IRR of 50%, 40%, and 25%. And the three values that we have calculated in T number 5, corresponding to the three percentages of 30.4, 7.32, and 3.33. Now, let's return to our example. And let's return to the position of investor A, us, the first guy that enters. You can imagine that if investor A enters with a percentage today of 30.4%, which is the amount that we have calculated here, that corresponds to the percentage in T5, he makes a mistake. And you can understand why. If I invest today an equity stake of 30.4, and after 2 years, another guy gets in, and after 4 years, another guy that gets in, with a 30.4 equity stake today, in year number 5, I will not have still a 30.4%, because clearly, you can imagine, I will be diluted. And so I have to understand how much I have to buy today in order to maintain at exit the desired equity stake of 30.4%, which corresponds to the exit value of 11.39%. In order to do so, we have to introduce a concept which is intuitive and is called so-called retention ratio. Follow me in this reasoning. Retention ratio for investor A is a thing of this kind. We know that at the beginning of T0 we enter and our stake is the only one. So we don't share this stake with any other investor. However, we know that after 2 years, in year number 2, there will be another guy that will get inside and he will take a 7.31%. We can see it here. And we know that after additional 2 years, in year number 4, we will have another guy that will get in company with an equity stake of 3.33. So at the end of the day, what I'm saying is that you have to recalculate the percentage, because if 2 additional rounds of financing takes place, you will not have the 30.4% at the end of year 5, but not much less. That percentage doesn't keep your equity stake integrate, but strongly reduced, and reduced by an amount of about 89.36%. So if you want to have a 30.4% in year number 5, you have to buy an equity stake much bigger today. And this equity stake must be the ratio between 30.4, the equity stake that you want to have in T5, and the retention ratio, which is, as we have seen, given the dilution effect, only 89.36%, or an equity stake much bigger, which is 34%. So our investor A will invest 34% today, knowing that in 2 years' time and in 4 years' time, it will be diluted. And if it is diluted, it will end up exactly with the original equity stake of 30.4%. From now on, the reasoning is exactly the same. We can now apply straightforward the private equity method like in a single stage. So we know that we want to buy a 34% equity stake, and we know that the number of outstanding shares in the company before my entry is still 1 million, as per the previous example. So if we want to have a 34% equity, we will have to buy a number of shares for the private equity that, taken and normalized by the number of existing shares plus my shares, investor A, returns exactly an amount of 34%, which basically means that we are going to buy a number of shares corresponding to, roundings apart, 515,055 shares. So now, with the number of shares and the amount of the first round of financing, we can understand how much is the price paid per single share and the pre-money, post-money value during round A of our financing. Pretty much in line with the previous example. So let's go back to our exhibit. And again, let's make some calculations. We know that we want to invest, let's go back, 1.5 million euros here. We want to buy 515,055. So the price per share that we purchased the stock at, price per share, is our round A financing, 1,500,000 divided by 515,055 shares, or a 2.91 euro per share. And now we can close the loop calculating the pre-money and post-money valuation. We know, in fact, that essentially the company value, company post-money, company post-capital increase, post-capital increase, will be essentially a thing of this kind. We have the original number of shares outstanding, the shares in the hands of the founder, 1 million. We have 515,055 shares, and we know that the investor in the first round, us, has paid a price of 2.91 euro per share. So, as you can imagine, the value of this company will be, roundings apart, 4,412,312.76 and euros. And you can split this value into components. Again, the first component is represented exactly by the capital increase, our 1.5 million. Capital increase, 1.5 million euro to the private equity investor A, and the second one is instead the implicit value that you can give to the company, to the founder of the company, before the capital increase is launched. The pre-money valuation of this firm is essentially the value of about 2.91 million euro. Founder. I hope it is clear. This is the first step of our analysis. What has made the difference in between the single stage and the dual stage is, remember, in multiple stages, our investor is diluted. And for this reason, he must recalculate the equity stake that he has to buy in order to maintain the equity stake at the original agreed level with the investor. Hope it is clear. If you want, you can also look at your Excel file that gives you the same information, so that if you want to train yourself after this session, you can refer exactly to, again, our slide. Look carefully. In your Excel, you have your investor A that is entering in year number 0. You know that in year number 0, the initial number of shares is 1 million. And based on our calculations, you know that the investor will invest in a number of 515,054 shares with a price paid per share of 291, and for a total company value post money of about 4.4 million, which corresponds to a capital increase of 1.5 and a pre-money valuation to the founder of about 2.91 million. Please notice one thing. If we now want to keep going on the calculation and understanding what happens after 2 years and after 4 years, you can imagine the number of initial shares in year number 2 will be no longer 1 million, but the 1 million plus the 515,054 of the capital increase that took place in year 0. So, if we want to continue our elaboration of the example, we can understand what happens when, arguably, after 2 years, the second investor will get in with an internal rate of return of, in this case, 40% rather than 50%. Let's go back. In year number 2, another investor, investor B, wants to get in. And we know that investor B wants to have an equity stake. I mean, the implicit value of the equity stake in T5 is 7.31. If this guy must have 7.31, but he knows that after 2 years, another investor, investor C, will get in, he cannot simply buy 7.31 in year number 2, because otherwise in year number 5, it will be, in year number 4, will be diluted. So for this reason, we can apply the same methodology that we used for investor A and calculating its retention ratio. So again, we can take our calculation and say, so retention ratio for investor B will be essentially its equity stake, which is integrate in year number 2, but we know that in year number 4, it will be subject to a dilution corresponding to the 333% of investor C in year number 5. So its retention ratio is not full 100%, but 96.67%. So if I want to have an equity stake of 7.31, but I know that my retention ratio is not 100% because someone else will dilute me 2 years ahead of time to 96.67%. I have to purchase in year number 2 a percentage that is a little bit higher. So 7.6%. And 7.6% is the equity stake that investor B must purchase in T2 if I don't want to get diluted after 2 years' time. From now on, the story is exactly the same. What we are going to do is to calculate how many shares, given the investment at what price, and then the pre-money and post-money valuation at year number 2. Let's go on. It is a sort of training of our brain, if you want. With 7.6, if we want to have a 7.6 shares, we must solve the equation for the number of shares for investor B divided by, listen, the original 1 million plus about 515,000 shares of round A plus the number of shares for investor B. If we solve this equation for number of shares for investor B, we get that the second investor is going to buy the number of shares corresponding to 124,077 roundings apart. Which basically means that with an investment of 1 million going back to our original exhibit, this guy is going to invest 1 million. So given 1 million investment and given the number of shares I'm going to buy, so 124,077, I'm going to buy the shares at a price that corresponds to euro per share 8.06. Please look at the price here and look at the price here. The price here was 2.91, and it is the lowest price because the company is in the riskiest period of its life, 0, not in 2. After 2 years, the company arguably has become less risky, and that's why this commands a higher price of 8.06 euro per share. And now we can close the loop, because we know that the company now is in a situation where the company has 1 million shares outstanding, the founder, about 515,000 share investor A in year T0, and another 124,077 investor B in T2. Times how much? The most recent valuation of our company, times 8.06 euro per share. Again, what you can get out of this formula is that this value here represents the capital injection in year number 2, or the 1 million. But intriguingly and interestingly, what we get is, given the most recent valuation, 8.06, the value of the founder now, pre-money, is the multiplication of 1 million times euro 8.06, and the equity stake of investor A that entered in year 0 is now worth 8.06 times the 515,000 shares. The sum of the two being the pre-money valuation in the hands of founder and the previous round financing investor, investor A. And you can appreciate what happens exactly in your Excel file, because your Excel file is telling you exactly what is happening in 2 years' time. Look carefully. In year number 2, investor B gets in year number 2. Investor B enters when the number of shares outstanding is now 1,515,000. We know that in the second round, investor B will buy 124,000 shares, and that he will buy them at 8.06. So that the total number of shares after the capital increase will be 1,515,000 plus 124,000, 1,639,000 shares or so. Given the valuation of basically this amount, you see that the company value will be the total number of shares times the price paid, and the pre-money valuation to the founder, as you can appreciate here, is essentially the application of 8.06, the price, to the original number of shares of the founder, while instead the value attributable to investor A will be no longer the original value of 1.5 million, but arguably bigger. It has become 4.151 million. So essentially, we have completed stage number 2 of our investment. And we can now close the loop with the final investor that is entering after all the other guys. And you can imagine that his retention ratio will be exactly 100%. Because from year number 4 to year number 5, no other investor gets inside. So basically, what we do is to say that, in a sense, the retention ratio for our third investor is exactly 100%, because no one else enters after this guy. So from this point of view, its equity stake remains unaffected, 3.33. And if you want to have a 3.33% after the capital increase, you must solve the equation for the number of shares for investor C divided by essentially the first round founder, 1 million, the second round about 515,000 investor A, plus round number 2 investor B, about 124 million shares, times plus the number of shares for investor C. If you solve the equation for number of shares for C, you will calculate the number of shares purchased in the third round to be 56.542 shares. And as you remember, investor C is willing to deploy 1 million investment in the company. So the price per share paid for round 3 in T4 will be essentially your investment, 1 million euro, divided by 56,522 shares. Or, in this case, a value of about 17.69 euro per share. Again, please compare this value with round B and round A. In round B, you have essentially the price per share of 8.06, in round A 2.91, in round C 17.69. Risk is lower, price is higher, return is lower. So that at the end of the day, the value of the firm post money in T4 will be essentially the original founder position, 1 million, the shares purchased in round A, 500,000 or so, investor A, the purchase, the capital increase in T2, investor B, and the final 56,000 round C in year number 0, 2, and 4. Times what? Again, times the implicit value that the company receives in the third round of financing, 17.69 euro per share. So that the total value of the company in year number 4 is, roundings apart, about 30 million euros. Which basically, again, I'm sorry to be boring, but it is the price to pay to conclude the exercise. Is composed by the capital increase in the third round, 1 million, It is composed by the pre-money valuation attributable to the founder, the pre-money valuation in year number 4 attributable to investor A, and the pre-money valuation attributable to investor B in year number 4. And as you can appreciate, this is the closing loop of our Excel file, because the Excel file will tell you exactly what is going to happen. In year number 4, we know that investor C gets insight here. He enters in year number 4. The number of shares at the beginning of year number 4 is 1,600,000 and so, 600,000 and so, composed by the 1,000,000 founders, 515 and 124,000. We know that the number of shares purchased by investor C is 56,000. We know that the price paid is 17.69. The number of shares after the capital increase is 1,695,000 shares for a total company value that you see here, 30 million, to be essentially the number of shares outstanding at the end of year 4 and the price paid in the last round of financing. And this value can be split into the 3 components. As you can see here, the capital increase in year number 4, the value attributable to investor B in year number 4, the value attributable to investor A in year number 4, and the implicit value attributable to the founder in year number 4. I believe that everything is now pretty clear. Let's clean up a little bit our Excel file and then let's close the analysis. Now focus clearly on the final point. The final point is what we started from. We know that in year number 5 the company is, if everything holds true, worth 37.5, which was, as you remember, the 2.5 million net income times the price earning of 15 times, 37.5 million. If you look at 37.5 and you know that the number of shares outstanding in year number 5, the exit for investor A, are still represented by 1,639,000 and so, you can imagine that the implicit price per share will be essentially what? The final number of shares in year number 4, 1,695,652, that are taken as a denominator compared to 37.5. So the implicit value of the shares in year number 5, if everything holds true, is 22.11. And if we take the overall number of shares for a value of 22.11, you can immediately spot the values that corresponds exactly to our original valuations. We know that the pre-money value to the founder is about 22 million. The value to investor A is 11.39. Do you remember? 11.39 is this number. 2.744 million. This was this number. And 1.225 million. That was our original number in year number 3. So, guys, it has been a little bit quite, I would say, boring, if you want, session, because when we have to work with numbers, we have basically to take into account a number of things. But however, I believe that by the end of this session, you now know exactly what private equity method, venture capital method is, what is the variant of this method applied to one single stage, and how to adapt this kind of method to multiple stage finance. I truly hope you have enjoyed the session. The next step that we are going to analyze in the following session will be, we have analyzed a little bit of how to protect ourselves against potential dilution effects. We must recalculate our percentages in order to avoid the dilutive effects. Are there any other protections that we can use in order to protect ourselves against the dilutive effects in the world of venture capital? The answer is yes. We can have the possibility to include covenants in the shareholdings agreement when we enter, or we can use a different security design in order to avoid the trap of being screwed up in terms of lost value in our investment. We will see, however, these 2 points in our next session. So again, thanks very much and see you there.